Hello and namaskar viewers. I am Sanjeev Pandya welcoming you to this week's episode of the Tax Talk with AJ. The show is sponsored by Sai CPS Services, a full-fledged professional accounting firm located in the state of New Jersey. A firm which is known to do taxes right, whether it's a personal taxes or corporate taxes, small-size businesses, mid-size businesses, or even large businesses. Their clientele are spread out throughout the country. So wherever you are, you can contact Sai CPS Services for all your accounting or bookkeeping problems. They can be reached at 908-888-8900 and their website is saicpsservices.com. They're knowledgeable, experienced and extremely helpful CPAs on hand will assist you with any tax matter that you have, any tax matter related to India or wherever country that you come from or even in the USA. So they can help you out, and we thank Science CPA Services for sponsoring the show, The Tax Talk with AJ. With that note, I'd like to welcome Mr. AJ Kumar, CPA, CVA and MBA with over 25 years of experience with Science CPA Services, who joins us every week to guide us, educate us and inform us taxes related matters as well as business related matters, and his knowledge is extremely helpful. So AJ, with that note, welcome to the show.
Thank you, Sanjeev, and thank you for the kind introduction.
Absolutely, you deserve it, and whatever I say, it's all right. Absolutely correct about Science CPA Services and about you. We are so thankful. All right, and now today's topic is very interesting topic, and I am sure that's going to relate to most of it, if not all of our viewers on ITV Gold, and the topic is capital gains. There's always a capital gain. We are a community that we invest in the businesses, in the various businesses, and we want to make sure that we make profit on those businesses. So there's a capital gain. Now, how much tax to pay on a capital gain, how much not to pay, what are the situation? Because every single industry's capital gain tax is a little bit different, but AJ is going to give us a complete overview on how to avoid capital gain taxes. It's not that you don't pay taxes, but wherever it's not necessary, you can save the money and still pay the taxes which is due. So in this two-part series, AJ is going to guide us through entire capital gains tax matter, how to avoid unnecessary tax on capital gains. Am I right, AJ?
Absolutely, Sanjeev. So capital gain is one of the most talked about topic. We have identified 10 main strategies for our viewers. We'll try to cover 5 this week and 5 in the next week's episode. So today we'll be talking about how to minimize, how to avoid capital gain taxes.
Yep, absolutely. Now, when you say how to avoid capital gains taxes, right, this is a very broad term. So let's just start with the basic situation, basic detail that capital gains tax, reflects on the tax return. And where does the capital gain tax start with? First of all, what percentage and where does it start?
Absolutely. So let's take a step back. Let's understand what is capital gain tax, how much is capital gain tax, and how does it work. So if number one question that we are asked all the time is how do I minimize my taxes? In general, nobody wants to pay taxes. Everybody wants to pay their fair share, but nobody wants to pay extra taxes. So everybody is asking the same question, and the typical response is it depends on how much income you have. It depends on what type of income you have. Do you have active income? Do you have passive income? Do you have capital gain? Do you have regular wages? Do you have long-term capital gain, short-term capital gain? So there are a lot of factors that depends. Not every dollar that you earn is taxed at the same rate, and that's where the capital gain tax hit. The capital gain tax can come from selling of a business, selling of an investment property, selling of an asset. Even the stock sales could create long-term, short-term capital gain. So let's understand the difference first. Let's understand the tax rates before we dig into the strategies that we can use to avoid or minimize capital gain taxes. So capital gain taxes could be of two types. Capital gain tax is created by selling an asset. Asset could be investment property, asset could be stocks, asset could be business. Selling an asset creates capital gain. If you acquired the asset and sold the asset within 1 year, meaning if the date of sale minus the date of purchase is less than 1 year, that's a short-term capital gain. If it's more than 1 year, meaning if you had the ownership of the asset, if you held the asset for more than 1 year, it's a long-term capital gain. Now, anything that you have, your W-2 wages, your capital gain, your active income, your passive income, is taxed at two levels. At the IRS level, we call it federal government, or at the state level, let's say New Jersey in this example. So any income that you have, active income, passive income, including capital gain, is taxed at two levels, IRS level and state level. Now remember, capital gain can be of two types: short-term capital gain, less than 1 year, and long-term capital gain. So let's talk about short-term capital gain first. Short-term capital gain is taxed at the regular income tax rate. Regular income tax rate for IRS is 10% to 37%. So when we talk about short-term capital gain, you bought something and you sold it within a year. That's like regular income. It's not capital gain for all material purpose. When we talk about capital gain, we are generally talking about long-term capital gain. And that's defined as you held the asset for more than 1 year. All the strategies that we are going to be talking about, all the write-up that you see on internet are defining capital gain and avoiding the capital gain tax, is all focusing on long-term capital gain taxes from the IRS level. Now, let's take a step back. How much is the tax rate now? For long-term capital gain tax rate, the maximum tax rate is 20%. There are three brackets: 0%, 15%, and 20%, and that depends on your income level, how much income you are making. From New Jersey, from a state perspective, the state does not recognize long-term or short-term. For a state, it's all equal. Everything is short-term. And the state income tax, I'm talking about New Jersey here, every state is different. We can talk about New York, Connecticut, Philadelphia, anywhere you want. For New Jersey, the tax rate varies from 1.4% to 10.75%. Regular income tax rate. It doesn't matter if you held the asset for more than 1 year, less than 1 year. There is no long-term gain from the state of New Jersey perspective.
If it varies, let's say from 1.4% to 10.75%, right? And there is no short-term or long-term categories in the New Jersey state taxes, right? So why this interest rate varies is because of the industries, whether it's a real estate, whether it's a business, restaurant business, or any other business. Is that, or even a stock market portfolio, whatever it is that the reason the rate varies?
A great question, and I should have clarified. So if you take a step back, IRS regular income tax rate varies from 10% to 37%. It doesn't depend on the industry. What does it depend on? How much money you are making.
Correct.
More money you make, higher the income tax rate. Same way, similarly, for New Jersey, instead of 10% to 37% for IRS, these rate varies from 1.4% to 10.75%. And that depends on how much money you are making.
Okay.
More money you are making, higher the tax rate we will charge.
Okay. Now, New Jersey's tax rate that you mentioned, but since our show goes, across 50 states that they watch us on ITV Gold and on Sling, just a basic question: do you know which state has the highest, state-wise capital gain tax rate?
Each state is different.
Correct.
There are California, New York, they are notorious about having the highest tax rate.
Correct.
But for the purpose of discussion as how to avoid the capital gain tax rate, if you take a step back, New Jersey varies from 1.4% to 10.75%.
Correct.
And it looks scary high. But 10.75% means you are making $1 million more plus. In that case, your IRS tax rate is 20%. And there could be net investment tax of 3.8% in addition to long-term capital gain tax. So all the tax avoidance that we are talking about, they all start at the federal level. Just because the federal tax rate is much higher than any state tax rate. So the question is, which state has the highest capital gain tax rate? Take a step back. The easy answer is federal government has the highest capital gain tax rate. So all the discussions that we have, all the internet search, all the Google search that you will see when we talk about how to avoid the capital gain tax rate is all focusing on IRS level. a lot of these states will follow the IRS ruling. So if you focus on IRS, how to avoid the capital gain tax rate at the IRS level, at the federal level, a lot of these states will fall through the same process.
Okay. So now with that note, the short-term and capital gain what you just explained. Now, industry-wise, it doesn't make a difference. State-wise, it makes a difference. Short-term rates are normally higher, so it is advisable to hold on to that sale or whatever it is for more than 12 months, so that way you can save substantially on a
Absolutely.
long term.
100%.
Right?
At a high level, the way you want to see it, at any income tax bracket you are, your short-term capital gain tax rates are generally twice double of the long-term capital gain. So your highest income tax rate is 37%, your highest long-term capital gain tax rate is 20%. If you are paying 15% long-term capital gain tax rate, then more than likely you are around 30% in the regular income tax rate. So your regular income tax rate, generally speaking, are twice of the long-term capital gain tax rate.
Okay, very well. This has been a very, very useful information. Viewers, as you know by now, that we are discussing avoiding capital gain taxes. That is the topic in today's episode, and this is going to be the two-part series. So this is the first episode. Next week we'll have a second episode where AJ will cover the rest of the points. But it's all about avoiding capital gains tax, qualified small business stock, primary residence exclusion, tax loss harvesting, tax credits, qualified opportunity zone funds, donate appreciated assets, 1031 exchange, then charitable remainder trust, and of course step up in basis in death inheritance. That also falls in the capital gains. So overall, we're going to find out from AJ that how to avoid capital gain tax. It's going to be very informative. Let's take a short break. When we come back, we'll continue the discussion on this matter. Stay with us. Welcome back to the second half of the Tax Talk with AJ. The show brings you all the information that you really need to know related to taxes. And the show is brought to you by Science CPA Services. Remember, when it comes to taxes and accounting, Science CPA Services should be your one and only choice. Science CPA Services can also help you with bookkeeping services, virtual CEO, virtual CFO. While you focus on your business, they will do all the back end work for you. So that way, you focus on your business and then your taxes are done right. That's what Science CPA Services is all about. And this part of the show, the second segment of this show, the Tax Talk with AJ, is proudly sponsored by Suhag Jewelers. Suhag Jewelers is one of the oldest and the finest jewelers on Oak Tree Road in Islin. They are very well known for their reasonable prices, beautiful collection of gold, silver, diamond, platinum jewelry, and very, very courteous customer service. So make sure to visit Suhag Jewelers, the showroom, or suhagjewelers.com to make your next purchase of gold, silver, diamond, platinum jewelry. With that note, AJ will have the gold rate information from Suhag Jewelers for you.
Absolutely, Sanjeev. So today's rate was $4,070 per ounce. The rates have been fluctuating. It has been going up and down. In last few weeks, the highest we have seen is $4,400 per ounce. If you take a step back, 1 year ago, the rate was $2,560, $2,560, which has seen 60% increase in gold prices over last 1 year.
Absolutely.
So gold prices are expected to continue to increase in the long term for next 12 months. It may not be next 60%, but they are expected to continue increasing.
All right, and gold investment is always a safe investment. So make sure that you decide to purchase a gold or gold jewelry or a gold bar at Suhag Jewelers. And we thank Suhag Jewelers for sponsoring the second segment of the Tax Talk with AJ. So here we are. Today's topic is how to avoid taxes on capital gains. We got basic information, short-term, long-term capital gains and the percentages from AJ. Now let's quickly move on to the other topics. Tax loss harvesting. What is it all about and how does it work?
Absolutely. So for our viewers who are joining in, we are talking about minimizing capital gain tax. This is part one of avoiding capital gain taxes. We intend to discuss 10 strategies in this episode and next episode. So the next strategy that we want to talk about is a capital loss harvesting. as the term says, when you have lot of investment in the stock market. This is specifically related to stock market, this strategy. When you have lot of stocks in lot of investment in the stock market, you will find yourself in a situation that some stocks have grown a lot and some stocks have lost a lot of value. So when you have lot of gains to report, when you have large capital gains, try finding the stocks where you have lost money. If you can sell some of those stocks which you don't have to keep or don't want to keep, or you're not expecting a lot of fluctuation and these stocks have gone down in value, by selling those stocks you can create a paper loss. The stocks are already losing value. You can create a loss that can be offset against the capital gain. Just remember the wash sale rule though. Don't try to buy the same stock or similar stock within 30 days. So the rule is you cannot be selling or buying a similar security 30 days prior or 30 days after the sale. They call it 61-day wash sale rule. Just be careful about the wash sale rule, but take a look at your portfolio. Call your investment bank to see how much is the capital gain that you have. What are you expecting to receive on 1099? Then you have them identify the stocks, the securities where you probably are losing money. You sell the securities so you can create the loss and you can buy them back after 31 days again.
All right, so that's on tax loss harvesting. Now let's just talk about the primary residence exclusion, because this is one of the very, very popular, I guess, area where capital gains works very well, and there's always a very, very handsome profit made on a primary residence when they sell it.
Absolutely, Sanjeev. And the worst part is a lot of people don't know about it.
Yes.
We get this question all the time. I'm selling my home and I bought it for X amount, I'm selling it for Y amount, I have 200,000 of capital gain, how much tax am I expected to pay? And the short answer, the sweet answer is zero, none. So there is a primary home capital gain exclusion rule which says married filing joint couple can exclude up to $500,000 of capital gain on their primary home as long as they have lived in that primary home for at least 2 years in the last 5 years. So a lot of people come to us, I'm moving to a bigger home, I'm moving into a new home and I want to put my old home on rent. And I tell them, if you intend to sell it, please try to sell it in 3 years. And why 3 years? Because the rule says you have to be living in that house for at least 2 years in the last 5 years. So if you sell the house in the first 3 years, you can avoid the capital gain completely as long as it's under $500,000. If your capital gain is more than $500,000, you may have some taxes, but avoiding the capital gain on $500,000 can potentially save you $100,000 just at the IRS level.
That is a very, very helpful information, and you rightly said that not too many people know about it, and that's why we bring you this show, so that way you come to know what's really to your benefit. AJ, I really want you to talk on 1031 exchange, but before that, I know we're going to be pressed for time because 1031 exchange is also very a popular area when it comes to real estate. Before that, can we jump into opportunity fund zone quickly and then talk about 1031 till the end of the show?
Absolutely, either way. So 1031 exchange is hot. Everybody wants to know about 1031 exchange. We'll discuss swap till you drop strategy. We'll discuss the cost segregation study when we talk about 1031 exchange. So the topic for 1031 exchange, Sanjeevji, can be its own episode altogether. But
so we'll continue after a little while after this opportunity fund zone, so that way we complete 5 categories, and whatever we are left with 1031 exchange, we'll cover it in the next episode to start with that episode.
Absolutely, and there are, as you rightly pointed out, there are a few more strategies that we want to discuss anyway. I mean, qualified small business corporation, QSBS investment is a beautiful thing.
Correct.
Captive insurance is another thing. So there are several strategies that we'll try to bring specific to capital gain taxes. But in the interest of time, let's start. I don't
want to rush into 1031 because you really need to give out valuable information on 1031. Let's talk about this opportunity fund zone.
Absolutely, Sanjeevji. So qualified opportunity zone. There are certain zones, certain areas that are created where if you invest money into those areas, you can avoid, you don't have to pay the capital gain taxes. So the rule was 10 years. If you remember, in TCJ, in Tax Cut and Jobs Act that came in 2017, this is when it was made popular. And from 2017, they gave this rule till 2026, 10 years rule. So if you keep the money invested into qualified opportunity zone for 10 years, then you don't have to pay any capital gain taxes. Now, with the new OBB1, One Big Beautiful Bill, the rule has been changed. Now what they do, if you keep the money invested for 5 years or 7 years, not 10 years, you still have some benefit. If you keep the money invested for 5 years, you get 10% of a step-up basis. 7 years, you keep 15% of step-up basis. So they have tried to make that rule better. You don't have to keep the money invested for 10 years. If you keep the money invested for 5 years, you still have some benefit. But remember, the concept here is qualified opportunity zone are the areas where many people are not investing. Think about it. Why would government has to go out of their way to make you invest money into certain area? Because those areas are risky. Nobody is investing money. So the government is coming up with incentive, with tax benefit. So the point is, be careful when you are investing money into qualified opportunity zone. In order to save $1, you don't want to lose $10. So the onus, the responsibility remains on you to ensure that the investment is safe. But in principle, investing money into qualified opportunity zone and keeping the money for at least 5 years now, used to be 10 years prior to one big beautiful bill, can potentially save you a lot of money on capital gain taxes. You can potentially avoid paying capital gain taxes completely if you keep the money long enough over there.
All right. So just to understand correctly and summarize it, that if you invest in qualified opportunity zone, even though with the government incentives, you could still end up losing the money?
Well, it's an investment.
No.
Investment is not guaranteed. It's never guaranteed. So we are not guaranteeing your principal. We are saying if you keep the money invested in there for n number of years, you don't have to pay the capital gain taxes. But
That's
let's
a
say
5 years. That's a 5 years. You said.
5 years gives you 10% of step-up basis.
Okay.
It used to be 10 years,
Okay.
and there was no 5 year or 7 year. Now with one big beautiful bill, they have tried to make it a little better. That you don't want to keep the money for 10 years, keep it for 5 years, and we'll give you 10% of the step-up basis. If you keep the money for 7 years, we'll give you the more step-up basis.
So government really, really wants people to invest in this because these are the whatever the categories are, the
These
areas
are the areas that are not developed properly.
not developed, and they
So
they
let's say,
need
for
investment.
example, in New Jersey,
Yeah.
if you take Newark, there are certain portion of Newark, there are certain portion of Trenton.
Or take Camden, for example.
Camden, right.
is one example. yeah.
Exactly. So nobody wants to go there.
Rundown cities, yeah.
It's a rundown city. No, it's not safe to invest. But if
Yeah.
you invest money, if you buy properties over there, if you buy rental houses over there, rental apartments over there, then government allows you to avoid, to defer certain portion of the capital gain
Okay,
taxes.
that's a good information to know. All right, so now let's talk on 1031 exchange. This is for real estate. And viewers, I want to let you know that we may run out of the time during this, but we'll continue, we'll pick it up in the next week's episode. Remember to make a note, this is the two-part series and this is the episode number 1. So here is 1031 exchange for real estate investors.
So essentially, 1031 exchange is an IRC code, Internal Revenue Code. This code means that I'm not selling anything, Mr. IRS. I'm just exchanging. I'm selling one property only to buy another property for equal or higher price. So essentially, I'm not getting any benefit of money. So we'll discuss 1031 exchange in our next episode. We'll also discuss how to maximize the benefit of 1031 exchange, meaning how to do the cost segregation study. So you can increase the depreciation to get the maximum benefit out of 1031 exchange. Then you will hear a lot of arguments on the internet that 1031 exchange is not saving any money. It's not saving taxes. It's only deferring taxes. You are just kicking the can for the future. You don't have to pay it now, but you have to pay it in the future. And we'll tell you how the swap till you drop concept works. When you give this property to the next generation, at death, the value of this property is given to the next generation at market value. So if you can keep doing the 1031 exchange and you give this appreciated property to the next generation as part of your asset, your next generation, even if they sell it immediately, they don't have to pay any taxes. The concept is swap till you drop, till you die. You keep swapping, keep exchanging it, so you can avoid paying capital gain taxes completely, not deferring it, avoid.
Avoid
You
it.
don't have to pay it completely.
Right.
A lot of big money, a lot of net worth is created through 1031 exchange only. So please don't miss the next episode. We'll be talking about cost segregation study. We'll be talking about 1031 exchange. We'll be talking about swap till you drop in 1031 exchange, and we'll have few more strategies for you to avoid capital gain taxes.
This is going to be great, very interesting episode. This has been interesting, very informative, and the next episode is also going to be more informative, folks. So we are hoping that you will join us in the next week's episode, where he's going to talk about, AJ is going to talk about 1031 exchange, and there are also several other topics that we need to touch base on this category called avoiding capital gain tax. You are avoiding it, that means you are just reducing your tax liability. It's not that you're not paying taxes. Science CPA Services and AJ believes in doing taxes right. So you will be paying taxes, but there are certain ways that you can hold on to some things. You can wait for a few days and then pay the taxes. That's what it's all about, because you may not know everything. And that's why we bring you this show. AJ, thank you so very much.
Absolutely. It's my
All right.
pleasure.
And we thank Science CPA Services and Suhag Jewelers for sponsoring this show, The Tax Talk with AJ. Until we meet again, same place, same time, have a tax-free days ahead. So long.